This is your friend, Marcus. Now Marcus makes really good food, like legitimately good. People who've eaten at his place keep coming back. So Marcus decides, you know what, I'm gonna open a restaurant. He's been saving up, got about $20,000 set aside. But here's the problem. $20,000 is not enough. You need a space, equipment, supplies, a couple of staff members to actually run the place. And you need enough to cover at least the first few months, rent, payroll, ingredients, before the money starts coming in. That's a lot. So Marcus goes out and finds a way to make it work, finds a space, gets the equipment, hires a small team, and the business, it actually starts doing pretty well. Now, fast forward 3 months, you run into Marcus. You're catching up, talking about how the restaurant's going, and he mentions, hey, I'm thinking about redoing the interior. New look, better vibe. What do you think? You listen, and then you say, I'll give you $100,000 if you give me 10% of this business. You become what's called a silent partner. You put in money. You don't run the place. You don't show up to work the grill. You just own a piece of it. Now, at the end of the year, Marcus sits down and does the math. After every single expense is paid, rent, staff, food costs, utilities, everything, the restaurant made $250,000 in profit. There was also a guy, Daniel, who had lent Marcus money early on. A loan, a fixed amount, fixed return. Daniel gets paid back. His loan, plus his agreed interest. That's it. He knew exactly what he was going to get from day one. But you took a different kind of risk. You believed in Marcus, in his cooking, in his ability to run the business. You didn't get a fixed return. You got 10% of whatever was left after everything was paid. 10% of $217,000 in remaining profit. That's $21,700 straight into your account. Now let's talk about what just happened here. In financial terms, Daniel, he's what we call a bondholder, a debt investor. He lent money. He took lower risk, and in return, lower reward. Predictable, yes, but capped. You're an equity investor. You took on real risk. If Marcus's restaurant had failed, and restaurants do fail, your $100,000 could have gone with it. That's the deal you signed up for. But because it worked, you got rewarded for that risk. Lower risk, lower reward. Higher risk, higher reward. That's the foundation of every financial market in the world. Now, a few years go by. Marcus's restaurant isn't just one location anymore. It's a brand. There are locations across the country. The name means something. People trust it. And Marcus starts thinking, what if we went even bigger? To do that, he needs a lot more capital than any one person can give him. So here's what happens. The company gets divided into millions of tiny little pieces, called shares. And those shares get listed on the public stock market. Now, anyone who believes in what Marcus is building can buy a piece of it, even if it's just a small piece. You don't need to be rich. You don't need to know Marcus personally. You just need a brokerage account and a decision. This process of a private company opening itself up to public investors for the first time is called an IPO, an initial public offering. Why do companies do it? 2 main reasons. 1, they want capital to grow. New locations, new products, new markets. 2, sometimes they want to pay off existing debt and clean up their balance sheet. The details of why a specific company is going public, that's in their documentation, their prospectus. Always read it before you invest. So Marcus's restaurant goes public. The IPO price is set. Investors apply. And when it finally lists on the exchange, let's say it lists at 40% above the IPO price, that 40% gain, that's called a listing gain. Some investors look at that and say, that's good enough for me. So they sell, right there, on the open market, to whoever's willing to buy at that price. And that's fine. That's how markets work. But others, they hold, because they look at the revenue numbers, the profit trends, the expansion plans, and they believe this company is going to be worth a lot more in 5 years than it is today. So they sit on it. Now, where does Marcus's company actually list? In the United States, there are 2 major stock exchanges, the New York Stock Exchange, the NYSE, and NASDAQ. The NYSE is the older of the two. Traditional, established, home to companies like Coca-Cola, Johnson & Johnson, companies that have been around for decades. NASDAQ is fully electronic, no trading floor, no shouting, and it's where most of the world's biggest tech companies live. Apple, Google, Microsoft, Amazon. Think of NYSE as the old money exchange, and NASDAQ as the new economy exchange. Both are legitimate, both are powerful. The difference is mostly in what kinds of companies choose to list there. Now, once Marcus lists his company and you buy shares, where do those shares actually go? Here's the simple pipeline. The Securities and Exchange Commission, the SEC, is the government body that oversees everything. everything. They approve companies before they can raise money from the public. They protect investors. They go after fraud. Below that, the exchanges, NYSE and NASDAQ, where the buying and selling happens. Your broker, the platform you use to actually place trades, is regulated by a separate body called FINRA, the Financial Industry Regulatory Authority. They make sure brokers play fair. And your shares themselves, they don't sit in a drawer somewhere. They're held electronically by an institution called the Depository Trust Company, the DTC. It's the backbone of the entire system. Every share bought and sold in the U.S. market is tracked and stored there, whether you know it or not. So the pipeline is simple. SEC approves. Company lists on NYSE or NASDAQ. You buy through your broker. FINRA watches the broker, and your shares live at the DTC. Clean, invisible, automatic. Now, one more thing before we talk about how you actually make money. You've probably heard the term S&P 500. Here's what it actually is. It's not a stock. It's not an exchange. It's a list. Specifically, a list of the 500 largest publicly traded companies in the United States. When people say the market went up today, they almost always mean the S&P 500 moved up. It's the single most watched indicator of how the overall U.S. economy is performing. And here's why it matters to you as an investor. Instead of picking individual stocks and hoping you chose right, you can simply buy a fund that tracks all 500 companies at once. When the overall economy grows, you grow with it. Automatically, passively. That idea alone has made more ordinary people wealthy than almost any other investment strategy in history. So, you've bought shares in a company. What actually makes you money? Two things. First, capital gains. If the business keeps growing, keeps reporting strong numbers, keeps expanding, more people want to own a piece of it. Demand goes up, price goes up. And if you sell when the price is higher than what you paid, that difference is your profit. Second, dividends. Some companies, especially large, established ones, share their profits directly with shareholders. Think of the big consumer companies, the ones whose products are in every home, every kitchen, every medicine cabinet. When they report strong earnings, they sometimes declare a dividend, a direct cash payment to every shareholder. For example, a company like Procter & Gamble pays roughly $4 per share every year in dividends. If you own 1,000 shares, that's $4,000 deposited directly into your account every year, just for holding. But here's the thing, dividends are never guaranteed. It's the board's decision, based on performance, strategy, and cash needs. Don't count on them. Appreciate them when they come. High-growth companies, they usually reinvest every dollar back into expansion, which means the returns you're after are capital gains, not income. Now, let's talk about something most people skip, and it's the most important part. The stock market is not just numbers on a screen, it is a reflection of collective human belief about the future. When people feel good, when the economy seems strong, when companies are growing, when there's optimism, markets go up, prices rise. Confidence prices itself in. When people are scared, recession, conflict, uncertainty, markets go down, sometimes sharply. And here is the pattern that has held every single time in history. Every crash, every recession, every crisis. People have always come back, rebuilt, moved forward. The market has always recovered, and then set new highs. There's a philosophy that Warren Buffett, one of the greatest investors who ever lived, has lived by his entire career. When everyone else is greedy, be cautious. When everyone else is afraid, that's when you step in. Buffett didn't build his wealth by predicting the market. He built it by buying great businesses at fair prices, and then doing almost nothing, just holding. For decades, it doesn't mean you time the market perfectly. Nobody does that. It means consistently invest through the good times and the bad. But when the market drops, when everyone's panicking, that's when you invest a little more. Because you're buying the same businesses at a discount. It doesn't matter if you're starting with a few $100s. If you apply that kind of discipline over time, your wealth can grow by multiples of what you put in. The story of Marcus's restaurant, that's not just a story. That is exactly how the real businesses listed on every stock exchange in the world got there. They started as someone's idea, someone's risk, someone's belief that people would show up, and somewhere along the way, they let the public in. Now you understand what you're actually buying when you buy a stock. You're not buying a ticker symbol. You're buying a piece of a real business, built by real people, serving real customers. And if that business keeps doing what it's supposed to do, keep growing, keep serving, keep earning, you grow with it. That's how the stock market works. Start learning. Start early and let time do the heavy lifting. Rich arc.